All right, well, welcome everyone, and thank you for joining our Trailblazers webinar today. My name is Cheryl O'Connor. I'm the CEO and co-founder of Income Conductor, an award-winning retirement income planning technology that engages your clients in the planning process and is built on a strategy that delivers income reliability, not probability. Joining me is my co-host, Mark Butler, a consultant to wealth management and wealth tech firms and founder of Wealth Management GPT. Good afternoon, Mark.
Good afternoon, Cheryl, and Happy New Year to you and your family. I hope you guys had a good holiday season, and we're right in the throes of what we expect in the Northeast from January, which is a lot of cold weather.
A lot of snow and cold. Happy New Year to you as well. Thank you.
Thank you.
So our Trailblazer series highlights the people in our industry who are forging new paths and developing new ways to achieve better outcomes for clients. We welcome your questions, so please type them into the Q&A box and Bruce will address them at the end of the webinar. So it's my great pleasure today to welcome our Trailblazer guest, Bruce Lavine, head of ETFs and chief operating officer at Astoria Portfolio Advisors LLC. Bruce has a long history in the ETF and asset management business, beginning with Barclays Global Investors over 20 years ago. He was one of the earliest employees at iShares and held roles there, including CFO, head of product development, and CEO of iShares Europe. In 2006, Bruce joined WisdomTree as president and chief operating officer. He was there for 15 years as an employee and a member of the board of directors. Before joining Astoria, Bruce was the CEO of an ETF startup called iShares. He has an MBA and Bachelor's of Science, both from the University of Virginia, and holds the designation of Chartered Financial Analyst. Welcome, Bruce.
Thank you, Cheryl. Great to be here.
Oh, it's wonderful to have you. So let's start out with how you started in the industry, and maybe you can give us your perspective on the evolution of ETFs over the past couple of decades and what has contributed to their growth.
Sure. So I was working at Barclays Global in the late 90s, and Barclays Global was a big institutional indexer for pension funds. And we were incubating this sort of strategic plan that had this thing that we internally named exchange traded funds. That was our code name for it because we didn't have a better one. And at the time, the category didn't really exist. There were spiders and cubes and diamonds. But when we filed in 1999, the press picked it up and suddenly the category was born. And, we at Barclays, we were managing money for single-digit basis points on big institutional mandates. And we looked at this as very attractive business as a way to break into a new customer base, advisors and retail at higher fees than we were getting. And just, there was a lot of reason to believe that it would be a very successful venture. So we launched it in 2000, and it's a long time ago in some ways, and very short time ago in other ways. It was a whirlwind. We had a business plan to educate the masses about what was going on with these newfangled things, and we were going to lose a lot of money and then make it up on the other side after we gathered a lot of assets, and that's what happened. So the early days were really interesting. It was a real challenge to educate about what these things were. One funny story I'll never forget, being in a focus group with some potential advisors, and we told them that it was okay to short the fund and that the fund could grow while people were shorting it. And this one advisor was just utterly convinced this was a Ponzi scheme that was absolutely impossible. And yet, that was a big part of how they started. The QQQ, as a matter of fact, started growing in the late 90s as the sort of more sophisticated people were trying to hedge their exposure on all those crazy valued tech stocks. So that's one reason it started growing. Anyways, we launched a suite of ETFs that covered indexes that people kind of knew, S&P 500, Russell 2000, and also gave deeper cuts to things that really had never been available to people, things like small cap value. We had country funds for Japan and Germany and France and things like that. And then we went out and told our story. And we were convinced from an early point that ETFs were a better mousetrap. They just had features to them that the advisors would like. And this was borne out in some of these focus groups. There's 3 or 4 main ones. The first one is just the transparency. Like, wouldn't it be great if you knew what you owned all the time as an investor? Because at the time, people had mutual funds and they would get semi-annual statements. And once every 6 months, they could look at some stale reporting that said, this is what you own. But, on a day when like the market moved a lot, they really had no idea what they owned.
Mm-hmm.
So being transparent was important. Being tax efficient, we had a mechanism, or we have a mechanism in ETFs that really prevent the distribution of capital gains on most ETF gains, and that's hugely valuable. People like the liquidity of being able to not only trade intraday, but choose the price for which they wanted to buy or sell. Again, when you use a mutual fund, you put an order in and you get the net asset value at the end of the day, and you don't know what that number is when you place the order. So you hope for the best. And that would come up, for example, on days when the market was violently selling off. Some people just wanted out. They didn't want to wait for the end of the day. They didn't want to be the last one holding the bag. So they liked that feature. They like the generally low fees. At that point, active management mutual funds were all in the 1% plus range. And here was a line of products, 20, 30 basis points, that people like that. I think also indexing was just starting to take hold back then. At Barclays, we were completely unknown as a company, and the only ones who we really sold to were pension funds, and they had that long-term mentality and had focused on indexing, but most of the world hadn't. So that was an important driver. And then the products they're incredibly flexible for the investor. The investor can buy or sell in any quantity that they want. They can hold for any amount of time that they want. They can be long or short. They can, in some cases where there's an option available, do a covered call strategy. There are just lots of ways that people ended up using them, and far in excess of what we had dreamed up when we had the business case going. So, and then it's just been a constant, continuation of the industry, both on the education side, and then as more sponsors got in, there's more product and more interesting product. And so the industry has been a very, very vibrant place for a long time. As a matter of fact, the total assets are now $10+ trillion in ETFs in the US.
It's amazing.
Yeah.
That is amazing. And I know it's taken, Bruce, it's taken a while for advisors to sort of make the migration, if you will, from mutual funds over to ETFs. And I don't know what the latest stats are, but I think, correct me if I'm wrong, I think there's a lot more money going into ETFs at this point than there are into mutual funds. Maybe just share some, looking back, like what took so long. The advantages are really clear. It took a while to get where we are today. And what are the lessons learned? Like, what should we as an industry have done differently, or maybe not have done anything differently?
Yeah, it's hard to say whether it could have gone faster. I mean, many ways, 10 trillion is nothing to sneeze at, right? And if you look at flow data, particularly on the equity side, for a very long time, equity ETFs are, dominating equity mutual funds. If you were to strip out 401k plans, where ETFs don't really play, and we can get into that, it's even more dramatic. Fixed income's a little bit different, a little bit less of an advantage maybe for the ETFs and flow data, but still, it's actually a pretty fast growing part of the ETF market. as is active management. You know, the original ETFs were all indexed. Now they're more active strategies, at least in the view of the SEC. I would still tell you that most of the ones that are even active still have that benefit of the transparency, which makes them slightly different than other active strategies. You know, in terms of advisors, the big shift that had to happen really to embrace these things was you had to become a fee-based advisor.
Mm-hmm.
You know, and that was the really big one. I mean, not that you couldn't sell them for a commission, but what you could do when you went fee-based is you really built portfolios with exposures, and you know, they're ideal tools for that. You know, one of the things about the transparency is if you're doing any sort of portfolio analytic tool, it's really good to know what you own. Right? It makes the analysis a lot easier. It's hard to do that on a mutual fund that doesn't tell you in real time. So if you wanted to look at factor exposures, or what the portfolio's dividend yield is, or what its price to earnings ratio is, things like that, you know, you have the ability to do it. So, you know, tools just kept getting created to make these things clear to people. And as they became fee-based, you know, you kind of needed a generation of older commission-based brokers to retire, you know, and pass the torch, and some of that happened. The other thing that was going on is the mutual fund companies, which have now all found the gospel and have mainly all jumped into the business, they were fighting pretty hard back then. They were, you know, really hoping this ETF thing would go away, that it was just a fad. They would spin yarns about how the cost was much greater than you knew because of all the trading that you would have to do in and out of ETFs. But nobody forces you to trade in and out of an ETF. You can do one trade and hold it for 10 years, right? So,
Right.
you know, but there are some very active traders in them because the products pull in some of the institutional trading community. And, you know, people like Jack Bogle would talk about how the average holding period of the spider was, you know, 20 days or something, but it was totally distorted data by the institutional trading community. And then mutual fund companies would scare investors that ETFs were going to take down the financial system in a time of stress. That same sort of logic of the person who thought it was a Ponzi scheme. You know, it was just sort of like somehow there's something wrong with the mechanism. It's going to get overloaded. And the reality is ETFs have been amazing in times of stress, like literally the go-to product to trade. You know, the ETF itself is, you know, it manifests the liquidity of whatever is inside the fund, right? So if you have large cap US stocks, it's a very liquid ETF. If you have high yield bonds, there's liquidity, but it, you know, reflects the liquidity of the underlying high yield bond market. So, you know, in some cases, if the high yield bond market freezes up a little bit, the ETF is actually more of a vehicle of price discovery than the bonds themselves in some cases. So anyway, they've held up really well. So as these arguments have sort of gone by the wayside, the ETFs have continued. And then I think, you know, a lot of the smartest people in the industry have found their way here. Hedge funds have gotten into the space with strategies that used to be only available to, you know, the well-heeled have found their way into ETFs. And it's just been a hotbed of innovation. So, you know, I think you'd probably have to say generally it's been a pretty successful transition. It's been 20 years, and they really have won the day against mutual funds largely, even though, you know, there's still a pretty big business in mutual funds. Yeah.
I would agree with that. You mentioned 401k plans at the beginning. Is that just a matter of time before 401k plans replace funds with ETFs, or is there something inherent in plans, or is it just the plan sponsors, it's in their best interest not to move to ETFs? What's going to cause a change there?
Yeah. So the ETFs are perfectly suitable for 401k plans. Two of their benefits, their main benefits, are really not as important. One is the taxation, right? Because everything's tax deferred. The other is the intraday liquidity, because you're hoping that your 401k participants aren't day trading their retirement money, right? So when those two go away, but what you're left with still is a wide choice of relatively low fee interest rate strategies that are absolutely substitutes for, mutual funds and other things. There is a little bit of a mechanism to, you know, you really what happened is the 401k, the way it grew up, there were no brokerages involved, right? So you have to kind of create a workaround to get people into the shares, a mechanism where they're sort of coming in at the end of the day. Those have been created. But to some extent, I think the development hasn't been that great there because one, the mutual fund companies have held on to that space tightly. They know that it's the one place where they're less disadvantaged, let's say. There's also a lot of decision makers in the process with a 401k plan. There's the plan administrator, there's all the service providers. And then when you finally get there, you have to talk to the participants. So, it just quite hasn't happened at the same speed. But I expect we'll keep chipping away over time.
Yeah.
And I think those positives about the ETFs, there may not be the need for tax efficiency or liquidity, but they certainly are much cheaper than mutual funds.
Yeah.
And, we were talking before, Bruce, I don't think a lot of people realize that within a mutual fund, there's a significant cash position.
It can be, yeah.
That can vary and, go up into 15, 20% cash. And people, when they buy a fund, I think they believe I'm investing 100% in this basket of, stocks and bonds or whatever,
Yeah.
which isn't true with the mutual fund.
I think one thing we saw from the start with ETFs is when people really got into them, they almost never went the other way. They never
Yeah.
said, I'm going to give up my ETFs and use mutual funds because, like once you get used to seeing what you own, for example,
Mhm.
and I don't want to give that up, right? Or being able to get in and out when you want to get in and out in the size you want to get in and out of, size and price, So I think that's the good news for the industry is it's kind of a one-way flow in the long run toward the vehicles. Yeah.
Yeah.
Hey, Bruce, we have a question. Hi, Bruce, it's Ben. ETF critics claim that passive flows and the popularity of leveraged ETFs have distorted market pricing signals, resulting in a gross misallocation of capital into the largest and hottest segments of the market. Do you see systematic risks to the marketplace given the price insensitive mechanistic activity of such flows?
Yeah,
Some
that's
big
a
words
really
there.
interesting question, and there has been a lot of talk about that. I'm not sure I have a very specific view. Absolutely, there's a lot of flow into certain parts of the market. Now, there's a lot of strategies out now. The ETF market's about 10% active, and there's many ways to take advantage of the herd mentality, if you want to go the other way. How much it distorts things, really, it's a bit of an academic thing that I have trouble getting my head around. The market tends to, whether it's through ETFs or some other vehicle, it just falls in love with certain parts of the market, and it just, until it doesn't. And so I'm not sure if it wasn't ETFs, it would be something else. But just to give you a little plug for Astoria here, like one of our funds addresses this issue of the massive concentration of the market. 7 names in the S&P 500 make up 40% of the market today. And so we have an equal weight product. Ticker is ROE, and it's designed really to be an alternative or a complement to your cap weighted products just for that reason, because it's possibly distorted. I don't know. To me, it feels more like the way of the world these days, that everything, goes viral and goes to an extreme and then goes back the other way. And so I think maybe that's what's going on in the markets as well. Yeah.
So it's more people driven.
Yeah. Look at Bitcoin, right? Is Bitcoin distorting the market? Well, it's its own thing, right? Is it distorting capital markets? Maybe. That's a really hard hard thing to get your head around. I've never seen a product that has really, really smart people on both sides so divided on their opinion about what it is.
Hmm.
Yeah. Let's see. Just on that point, well, certainly cryptos are a big thing going on in the ETF world, but there's just an immense amount of product and innovation that's going on. So whether it's a retirement account or any other, you can get exposures that you really just can't get in the rest of the market. Examples would be, WisdomTree had a floating rate note ETF, and that's pretty useful at times when you're worried about what's going on with the rates and you just want to, crest with the, match kind of the floating rate that's out there. There's buffer ETFs that will cap your upside and protect your downside. Um, there may be private credit ETFs in the near future, something that's new. We know there's Bitcoin, but in the coming year, we'll probably see a lot of other things going on in the land of crypto, particularly under this administration, who seems very friendly to it. So, yeah, it's there's a lot going on, and I think it's important for an advisor to really dig in a little bit because when you're trying to really meet your clients' needs, you have a lot of tools, but you got to utilize the tool set. And that starts with just at the very core, just understanding the mechanism, how, one, how a mutual fund works, two, how an ETF works and why they differ. I think you have to understand, well, there's 3,500 ETFs out there today, right? So you got to do, you want to try to screen them in some way, but you also want to not necessarily just cling to the top 50 from, iShares and Vanguard and State Street, because they're, that's not necessarily the most interesting things going on in the market right now. So you have to think about how you evaluate ETFs. And people use size of the fund, they use trading volumes, they use performance. And there's lots of ways to screen on these things, but it's worth understanding, why some of those screens matter and some of them don't actually. Good example of one that doesn't matter all that much is size of the fund. It's a mutual fund mentality that says, I don't want to be a large part of the fund because if someone else does something, they might impact my experience. They might cause me a tax event, or they might cause my portfolio manager to freak out and start selling everything. But that's not how an ETF works. An ETF, if one person wants out, they get a slice of the fund, they send out to them, the securities sent out to them. So there is none of that, like one investor is hurting another investor's experience. So that those kinds of things. So it's worth understanding how it all works structurally.
Yeah, for sure.
Yeah. And the good news is there's lots of resources out there these days. Lots of people willing to educate you. There's a whole, ecosystem around ETFs, places like ETF.com and ETF Action, those kind of places. Yeah.
Yeah, those are good sources.
Yeah.
Another question from one of our frequent listeners, John, what asset classes or strategies are sponsors still having trouble packaging into ETFs, and how do you think they'll overcome these hurdles?
Yeah. I mean, in my career, I've tried to package diamonds, physical diamonds. I've tried to package uranium. And it's just interesting when you go down the path with all of these. And what it really comes down to is, is the underlying asset fungible, or not? Because, if every diamond was the same as every other diamond, then you could have a diamond ETF pretty easy. But it turns out that's not really how it works. Whereas every gold bar is like every gold bar. And so some work, some don't. I've heard the private equity world, the venture capital world talk about getting into ETFs. That seems like a challenge. It hasn't happened yet. I don't quite see that one. Things like private credit that seem to be coming, they'll come, but probably as a piece of a fund, not the whole thing. So I think you might see some of these asset classes You saw this with like pre-IPO companies, like you'd have Fidelity funds owning a piece of Uber, right?
Mm-hmm.
You can do that up to a limit on the fund. Maybe it's like 15%. And so you'll see definitely those limits get pushed and less liquid stuff finding their way into a otherwise liquid ETF. And then, cryptos, how far that goes is a regulatory thing. And of course it's really unclear, how much depth the market would have for multiple cryptos as well.
Mm-hmm.
But you probably, if they exist, you'll start to see some indexing approaches around that as well. You'll see baskets of cryptos.
So we've seen this move from, a passive vehicle into more of a actively managed vehicle. In fact, I think you gave me a stat that actively managed ETFs represent 10% of the ETF market right now.
That's right.
We've seen, variations like derivative-based ETFs. You mentioned crypto ETFs.
Yep.
Where do you see the industry headed, Bruce? What are the trends and product innovation, that we can look forward to in the future?
Yeah, absolutely. Active management, there's various ways to think through that. There's the asset allocation decision, which, for a very long time, people have been using passive vehicles and an active asset allocation decision above them to implement. And that still remains a very popular way to do it. And ETFs are ideal for that. Then there's active management, like inside the fund itself, which you're starting to see more of. And it's, again, largely transparent active. Some of it's not transparent, but most of it is. And that grows because the mutual fund companies, among others, are just converting many of their strategies into ETFs. So you're seeing traditional, bottoms up star manager types, suddenly running ETFs. So that's increasing. So that should probably continue. You're also seeing a lot of growth in fixed income, and fixed income is a place where there's a much better argument than an equity space to be made for an active approach. Fixed income has the managers have a much better record of outperforming traditional benchmarks. So they'll be continued active there. And then, just again, more cross asset class, when you see something like Bitcoin and the returns that it's made over the past however many years, they're really stretching the band of returns of different asset classes. And so, we'll see the more of a premium probably on that asset allocation decision over time if there's more building blocks available in, quasi private markets and cryptos and who knows what else. But yeah, it'll continue to be.
Are there any regulatory hurdles right now that you wish would go away to kind of support this innovation?
It's interesting. Many have gone away in the last 5 years.
Yeah.
It used to be when I was at WisdomTree, we were the first ones that did active anything. We were considered a self-indexer. So we created our own indexes and then ran products against them. And that was very novel at the time. And now anybody can do that. Anybody can come and launch an ETF, which is one of the reasons you've seen so many. So the regulatory stuff tends to be on the really out there stuff these days, which is, again, all things crypto, private asset classes, and more of this leveraged and derivative kind of stuff, where, it could be 2 times levered, 3 times levered, potentially 5 times levered, right? Lots of issues for the SEC to deal with. Back to your question about active, one of the things we've seen is a bit of a barbell where you get investors that have a passive core and then get more active with some of this stuff. And you've seen more interest in these, very highly volatile strategies, which, if you get it right, can be great. And if you get it wrong, can be painful. So you've seen a bit of a barbell about where the assets flow.
Hey, Bruce, one last question here. Can we assume that an active manager buys the same stocks in their active ETF that they would buy in a less transparent fund or pool, or should we be skeptical?
That's a really good question. For the longest time, you know, one of the reasons the mutual fund managers didn't get into the ETF business is they didn't want to show their hand,
Mm,
right? They thought, well, we have the secret sauce.
Mhm.
Now, all the numbers would say your secret sauce wasn't worth all that much, right? Because indexing kept, you know, in aggregate beating up on active management. So they've gotten over that. I don't know. I'll be honest in saying, you know, I don't know if they've fully gotten over it or they're using, in some cases, proxy baskets, let's call it, you know, not the full portfolio. My guess is they're using pieces of the full portfolio, but the full portfolio probably has more holdings.
mhm.
And they're using, you know, a representative sample of it to do the ETFs. And to the extent that they think they have some very interesting ideas they don't want to share, maybe they don't share them.
Gotcha.
Yeah.
Good. Thank you.
Yeah,
Hmm.
of course.
So any more questions, Mark?
That's it. That's
All
it.
right,
You guys
well-
had some good ones.
We are past the half hour, Bruce.
Okay.
Maybe you could share with our listeners where you're working now. Congratulations on your new position.
Thank you. Yeah.
Where can they find information on Astoria?
Yeah, so it's AstoriaAdvisors.com. We'd love to talk to all kinds of advisors. We provide outsourced CIO services as well as running some ETFs, and it'll be well worth your time to have a conversation.
Wonderful. Well, thank you for spending your time to have a conversation with us and our listeners today. You're such an innovator in this space, truly a trailblazer. So we really appreciate your time and your expertise, Bruce. Thanks.
Thank you so much, Cheryl, for doing this.
Thank you,
All right.
Bruce.
Thank you, Mark.
All right. And thanks to our listeners. Be on the lookout for our next Trailblazer in February. Stay warm.